Hey, Courtney, yeah, markets taking increasingly seriously the words of Fed Chair Jay Powell at the Jackson Hole Summit last week, where his short but direct speech made clear the Fed's intention and his intention to hike rates and keep them high until inflation is brought under control. Take a look at the Fed fund rate outlook right now. Markets pricing for the peak funds rate in April, rising this morning to 396. Up from around 380 before Powell spoke. We're close to rivaling the high of this contract of 408 from mid-June. Markets still pricing in rate cuts next year, but those levels right now are well above where they had been. The latest surge in the rate outlook comes after Cleveland Fed President Loretta Mester yesterday said that her outlook sees the Fed pushing rates up to 4% or above 4% next year and maintaining that level.
It would be a mistake to declare victory over the inflation beast too soon. Doing so would put us back in the stop-and-go monetary policy world of the 1970s, which was very costly to households and businesses.
Rates are rising as some good job news comes in, though that might be bad news for the Fed. Jobless claims ticking down for the third straight week, and the employment component of the ISM manufacturing, which we got at the top of this hour, rising to its highest level since January. All that setting us up for the jobs number tomorrow. Consensus looking for 318,000 jobs, and the unemployment rate to remain unchanged at 3.5%. Wages forecast to rise a pretty healthy 0.4%. That would push that annual rate to 5.3%. So after a period of seemingly willful deafness, both the market and the bond and the stock market seem to have heard Powell's message. It's just not entirely clear the economy overall is hearing that message. There doesn't yet appear to be much softness developing. If that's the case, the Fed may have to be like that old Avis commercial and try harder, guys.
Yeah, we're number two. Steve, we've had a number of people. Jim obviously talks about it every day. Phil Camporelli talked about it earlier, that we're going to be focused on fewer jobs as a sign that things are working. Is that what we're going to need to? Or is that what the markets are going to be focused on?
I think that's what the market is focused on. As you may know, David, I have a slightly different contrarian opinion on this. I think putting more people to work is the answer to the inflation story. I think that will ultimately create the competition and the slack and the labor and the substance that will bring down inflation. But right now, both the Fed and the market would like to see more slack in the labor market. I want to put those people back to work who lost their jobs and get employment back to where it should be, which is well above the current levels.